welcome to TS's Finance Nuggets, your one-stop to turning complex financial concepts into bite-sized nuggets. In today's video, we'll be looking at what it is to analyze a stock. How do you decide whether to hold, buy, or sell a stock? There are various methods in which you can analyze a stock, but today we'll be looking at 3 of these methods. First, let's start with the PE ratio. The price to earnings ratio of a stock compares the current market price of these shares to its earnings per share. The lower the PE ratio, the cheaper the stock price is relative to its earnings. But watch out, a low PE ratio could also mean that the company is in trouble. Some people might be wondering, so how exactly do I watch out and choose a company with a good PE ratio? Well, there are no generally acceptable PE ratio. It highly depends on the risk and growth profile of the company, macroeconomic factors such as interest rates, and also the industry in which the company operates. So let's look at the PE ratio of 3 big tech companies, Apple, Meta, and Alphabet. We're going to be comparing their PE ratio as at October 10, 2024. For Apple is 34.85, for Meta is 23.8, while for Alphabet is 23.42. So if we compare the PE ratio of these big tech companies to another company in another industry, for example, finance, and we're choosing JP Morgan, the PE ratio of JP Morgan is 11.96. So in practice, most times, investor compares the PE ratio of a company against the industry average. So you compare the PE ratio of that company against that of its peers, and you decide whether it's low or high. Based on these findings, you decide whether you want to invest in this stock. Next is earnings report. Every quarter, public companies are obligated to announce their earnings to show how much they have made. When you're analyzing these stocks, you want to look at their earnings report to see if they have consistently beat expectations. So when a company has consistently beat expectations and you can see that there's growth over time, this is a good sign. It also shows that there's room for growth for the stock price of this company. Next up, we have trends. You can actually spot trends by looking at the stock chart, and a trend is the direction towards which the stock is moving. If a stock price is consistently going up, that's an upward trend. But if a stock price is consistently going down, it's called a downtrend. Moving average is one way to analyze this data more clearly. A moving average helps to smooth out the price data over a period of time. For example, a 50-day moving average smooths out the price data over the last 50 days, and if the price is above this line, it is generally a good sign. So how do you do this in practice? For example, you're invested in a stock such as Apple. First, you look at the price to earnings ratio to see if it's reasonably priced. Then you look at the earnings report to see if the company is profitable and if it is growing. Then you can analyze the moving average to understand if it's an uptrend or a downtrend. That's it for today's video. Give it a thumbs up if you found it useful and share with your friends that might be interested in investing in the stock market. Until next time, stay smart with your money. Goodbye.